And I hope they pass them out before the cocktail party. But if not, we'll pass them out after, and you can see how beautiful the printing was. Other co-sponsor, Make a Holiday Inc., makeaholiday.com. Will Michael Fugler stand up? Thank you. Thank you. So we want you to check that website out. We are a co-sponsor of the cocktail party with GLX. We're a wine importer. We too have a card that's with the same stuff, with all the bags coming, and we hope that you'll read it. But since you haven't had a chance to see it, after Ron speaks, sometime before we conclude, I will tell you a little bit about it. Now I'd like to go ahead and get started with the program. The two things are going to happen. One, Ron's going to tell you very briefly about GLX. Then I'm going to get up here, and we have a slew of experts that are going to tell you about technology, crowdfunding, Jobs Act, things that they're all doing, things that we're doing together, things that we're doing independently. CPAs, lawyers, technology people. We have brought together what we can consider to be some of the best to give you information. So please stick with us, because this is where we're going to need your help. Yeah, we need you to go to the SEC.gov and ask for an extension, but there's a lot more going on here. So Ron, you'll go ahead and tell us a little bit about GLX and what you have going, and then I'm going to come back to the podium and we'll pick it back up.
And I thank everybody for coming. Michael, thank you very much. And I'm going to talk very briefly about GLX, the global listing exchange, and glx.com. Our mission is really to develop the world's first global investment community. And if anybody knows anything about Facebook's goal, which is to make the world more open and connected, very similar, the goal at GLX is to make the world's financial markets more open, connected, and transparent. So to keep it very, very brief, a picture is worth 1,000 words, a video might be worth even more. That is, if we have a video. Well, we don't. But let's skip the video. GLX is a financial media holding company. The video would have told you more about glx.com, the social network, and the platform. But at the parent level, there's been a lot of action lately. We've acquired certain assets of value rich, and that's really sparked GLX, GLX events, GLX Digital Publishing. We'll be producing our first digital publication later this year, as well as a print book, GLX TV, which a lot of people see present. All these verticals in the financial media industry could be and will be absolutely massive businesses as a standalone. But we feel that if we apply social technologies and the social graph to the entire model, the whole thing could be much bigger. So all of these verticals as they build, and the really magical part about the GLX model is all of these verticals really drive the GLX brand and drive traffic to the glx.com social network. The glx.com social network, whole nother presentation. I can talk about that for a week, and I don't want to take up too much time. So that's the GLX model. The GLX team will be around, and we're happy to do one-on-ones on anybody that wants to learn more. Thank you very much.
Thank you, Ron. We appreciate it. So, as we're switching our projectors and computers here, we're going to talk a little bit about crowdfunding, Jobs Act, truth. There is a handout, and also it's loaded up on my website. That should be going out to you today. There's an article. There are those of you in here that already are very knowledgeable and very on top of it and have your own strategies going. And there are those people in the audience that know just a little bit. So we're going to try to build a very rapid history to give people some comfort for those that are in the room that don't have the background and history about it. And then we're going to move into very advanced information for those people that do and talk about how we can interact. As I'd indicated before, unfortunately I'm not in the book, but here I am, I'm Michael Fugler. I am no longer titled. I just call myself a critical thinker. and a creative thinker. Crowdfunding everything. I couldn't get any other name because when crowdfunding got popular, Steve Cohn knows, the domains went out the roof. But crowdfunding everything, I thought, well, everything you want to know about crowdfunding would be easy to find, and then my website. So, my opinion, I think, at the current time, coming out of the recession that we just went through, is a crowd capital formation is broken. And the more I got to giving speeches on the subject matter, the more I started thinking about simplicity, the real simple things. Like, if people that aren't accredited investors go on a junket to Vegas, does the SEC and FINRA jump in? I mean, if some guy is going wacky and they're going to spend thousands and thousands of their hard-earned dollars, a family vacation out of control, you hear it all the time. I don't care if we have money or not. My babies are going to Walt Disney World and we're going to spend whatever it takes. Does the SEC and FINRA jump in on that one? Credit cards out of balance. Well, look at all the debt counseling services, but I don't see the SEC and FINRA and all the regulators jumping in on that one. My God, you know, it's amazing to me that people talk to us about Wall Street, and I'm thinking, you know, it reminded me of that movie, Network. And I remember how good I felt. I'm mad as hell, and I'm not going to take it anymore. When Meryl Streep pushed that window up and stuck her head out the door, and whoever else was in that movie, I'm thinking, you know, I don't know if it was, but, you know, when you get to say that, it just feels so good, because this is the time for people to say it. And God bless the crowdfunding people that got it started. Because even though crowdfunding's got its own thing going, change is what's important. You know, Wall Street says, just look at the recent IPOs. And before Facebook, it was look at Facebook. Well, it didn't work out that well. But who in here got invited to Facebook? I mean, truly, how many people terribly interested in crowdfunding were a part of, gosh, you guys want to take some shares in Facebook before all this happened? And while we're on the subject, who is Wall Street? Every night when I'm watching TV and I look at the financial section, I'm thinking, listen to it. They're saying Wall Street thought this, Wall Street thinks that. Wall Street's not feeling good today. The markets are off and Wall Street's bad. And I start thinking about who is Wall Street? Is there some institution down there that hands out money that is the smart money? They call it smart money. And then I started thinking, where do they get it? You know, they get it from us. People on the street, people with jobs, people that are investing in the pension funds, insurance products, and mutual funds. All the small money, all the small businesses, all the people that are not the accredited investors get to give their money to those people that now, the money is now, it wasn't before smart money, but now it's smart money because we gave our money to the right people. I know my wife, we were trying to decide a few years back, we had made really good money in our investment banking deal. She gave hers to mutual funds because there was a close personal friend that had gotten licensed. I gave mine to Merrill Lynch. I was fortunate enough, I knew the lawyers that knew them, that represented them. I got the #2 team in the country, the case team out of Fort Lauderdale, Florida. I gave them all the money that I made the last 2 years, and they lost 65%. I let them do it because I thought they were smart money. And I'm not so convinced anymore that all these pundits and all these people that are managing money are so damn smart after all. But I do know where they're getting it from, and they're getting it from us, and they're getting it from our clients, and they're getting it from people. And there are a lot of people in this room that are no longer accredited. They were pretty smart when they were accredited, and I'll bet you're still smart today, and you ought to be able to do with your money what you want to do. And I am mad as hell, and I hope some people in this room will get mad as hell. But, you know, the politicians, the regulators, the wealthy who are controlling things have come together and by royal decree have allowed that some people are going to get to put a few pennies in to the crowdfunding mix and do something with it. Well, I think that's great. It's a start. It's a core. And I encourage you not to get turned off by it, because business ownership needs to thrive. And in order to get jobs, jobs come from small business. Entrepreneurship needs money. Now, yes, technology has helped, but in other words, in other aspects, it just added to the burdens that we need to know. More hats we need to wear, more things we need to know about. If we go back to the 70s, entrepreneur was sort of like not used that much. It was the guy on the street corner selling watches off his arm. But today, entrepreneurs will continue to succeed as well as fail. In America, it's a land of opportunity. Opportunity doesn't knock for entrepreneurialism, it lurks. Capitalism is alive and well and can work if we help it. Now is the time for change. In the beginning, we're readjusting to this new environment that bears repeating that we've been struggling with a recession, a bank crisis, a real estate meltdown, a technology shift. It may take a little more time to reboot, but we are making progress. This new law isn't that great, but it's a chance to start the whole new process. It's a chance to look under the hood at the engine now that the hood is up. That's what I'm trying to ask you to do today at this lunch. Look at the hood. Look under the hood. See what it is that is up under there that people are looking at crowdfunding the Jobs Act. Now, as we say, regulation is no guarantee. Madoff and Stanford both proved that. This is a hot topic. It's dealing with jobs, which we desperately need. There's a history you need to know about. I encourage you to look at the article that we wrote. I'm writing a sequel to that article, and anybody in the room that would like to join me and be a co-author, I welcome you on board. Just let me know. Reg D, general solicitation, general advertising. To use or not use it. What's that about? That's the issue that some people in this room are going to be concerned about. Broker-dealers or issuers that don't want to use the exemptions, want to keep it the way it was and do it the way it was. Are the regulators going to come out with a set of rules that say, okay, if you use it, you go down here and here are your rules, and if you don't use it, you don't have to because the rules are already set. 90 days. These are all things that I'm going down this list to encourage you in this room. These people are going to be speaking on these various subjects, and I'm going to fill in the void for those people and those subjects that aren't covered. Every one of these items is a piece of this puzzle of this new law. In 90 days, from April the 5th, when the law took effect, the SEC is supposed to come up with regulations. And those regulations right now are open for comment. And the people in this room, with the power that we have, the databases that we have, the knowledge and experience that we have, we can influence these rules. Think about the bipartisan effort of Republicans and Democrats, whatever that is, when they actually got together and passed this bill. That's what we should be proud of, the fact that it happened, the fact that we have a door open, a foot in the door, and it's up to us to keep it going. 2,000 shareholders. There's a change from 500. What's that about? IPO ramp. $1 billion. What's that got to do with? In crowdfunding, and $1 billion is starting to measure the size of a company that can participate or not participate in some of these new changes. $1 million. More down to crowdfunding. I remember when I first heard Congressman McHenry from North Carolina speak, and he said, look, I don't like it either, but we got it passed. And he said, I wanted $5 million. And then I bargained for $2.5 to get it through Congress. We have to educate our senators, because by the time they got through with it, it was one. But one's a start. 270 days, we talked about that with the SEC. Reg A, some changes there we're going to want to hear and know about. $50 million. That's what Reg A is going up to from 5. Blue sky, still an issue. And crowdfunding the next step. Now, this is my thinking, and this is where this new article, the sequel that I'm doing, is going to go. If you would look at the words as I come to the screen to your eyes and think about it, this is my suggestion of where we can focus and make comment. And what we shouldn't do, I don't think, is we shouldn't make comment that only takes care of us and our group, or them and their group. We should try to work together for the people that are trying to change the general solicitation. Open up capital formation. Make it easier for us all to raise capital. Help the crowdfunding people. Help the Jobs Act people. The issuers. There's 3 players here. The issuer, the platform, and the intermediary. Many issuers are here today. You're on the stage for 10 minutes a time today, throughout the day. The platform, we have one here, Vince. Vince is going to be speaking to you about gate technologies as one example of a platform. Gene, media shares, will talk to you about a different kind of platform. And all of us, investment bankers, broker-dealers, are the intermediaries. Those are the three players that I see. Education. The more I've had the opportunity to chair education groups and to go out and put presentations on websites and give speeches, the more I realize, from a regulatory perspective, the success of this program with crowdfunding, the success of the Job Act, is going to be for all of us to take accountability and responsibility, because we're in this business, to educate those people that the door is opening up for and being let in. We have to teach them. We have to educate them. Due diligence is going to be important. Sharing our knowledge is important, and that's part of the process. Our own websites, our own issuers' websites, our own clients' websites have to educate people, and in educating them, we're going to protect them. Investor protection. Sure, it's needed. But we can't just scream, oh my God, fraud, they're going to lose $5,000. People go to Vegas and lose that all the time, even if they don't have any money. Verify accredited investors. Yes, you're going to have to verify accredited investors. We're going to need a safe harbor. Whoops. You know, we did everything you said we're going to do, and we still sold some to some non-accrediteds. Don't put them in jail. Let's figure out a safe way to handle it. Structure. The structure of these deals are going to be critical moving forward with crowdfunding. And we need to help outline how that process and structure should work. Valuation. The biggest problem I see is who's going to decide and how are they going to decide, and who's going to educate and protect people on whether or not the companies that are coming out are valued properly. I have to tell you from my experience, and I know with Eric in the room, Eric Paulson, and some of the guys, you know, Chet's big deal is always, you have to bring them into a room and beat them up and put boxing gloves on, because everybody thinks their company is worth 3 times more than it really is. Facebook, the difference of opinion, but you know, valuation is a big issue here, and it's up to us to figure out a proper way for accountability on valuation. Transparency, so you can see it all, both sides, who are the issuer, who are the people that are putting their money behind it, the management behind it, the documents behind it. Disclosure. You have to disclose everything. Everything all of these offering documents ought to have a big, bold thing. Don't put your money in it if you can't lose it. And that ought to be, the risk factors, that's the biggest risk factor. Whether it's $100 or $1,000 or $2,000, don't play this game, don't get into it if you're not prepared to lose that money. So don't risk too much if you can't take it. The use of the proceeds and the truth about the use of the proceeds. So oftentimes in my investment banking career, I find that people put out a use of proceeds, and at the end of the day, I know we've had some very successful IPOs. A few months later, it's like, well, you didn't say you were going to do that with the money. You were supposed to get into marketing. You know, you're supposed to do this, and you spend it on something else. Well, you know, I changed my mind. Well, you shouldn't be allowed to make a change without sufficient justification to do so. Background, who are these people? You can't just put something up on the internet and nobody knows who they really are or what their real names are. Ways to control that. Liquidity, it doesn't matter if you have any or not. You know, non-traded REITs and some of the other issues that are out there don't have very much liquidity, but the point is, are people educated well enough when they go into it that you told them the truth about liquidity? No, you're really not going to get access to this for 7 years. Doesn't matter if anybody dies or whatever, you're not getting it. So we need to have plans for that. I think people need to be thinking about liquidity. Fees, who's getting paid what? Lay it on the table. Tell the truth about it. Risk, what are they? Spell them out. Exit, whether it's we're getting listed, we're going to be public, we are public, we're private, we're going to pay you dividends, we're going to share in the profits, we're going to take your money, we're going to stay private. You will never get a benefit out of us, ever. Thanks for the money. We give you a share certificate. We're going to put gold and 2 ribbons on it. It's really going to be cool. Whatever it is, there has to be some exit with all this. And with that, We're going to talk about our panel, let them come up here and talk to you, and then we're going to open it up. And all of this list, both of these lists, I'm going to have on my website. I hope that you will interact not only with the panel, but with me following on, because this is what I'm laying out. Maybe you've got a section that could go in there that I forgot about. Maybe you have some ideas on some definitions of rules, how you think a particular rule, whether it's disclosure, transparency, or risk, whatever. I know Carl's thinking hard, Carl Dillon, and he's going to come up with some ideas. I'll say this, I don't want to go into it deep. I know there are people in here from California. I know there are people in here that have experienced 25102N exemption. Very simply, it's just a sample, an example of how we could take this crowdfunding and move it up a notch, or as Emerald likes to say, kick it up a notch. And if you get a chance to look at the 25102N exemption, you can do 5 million, not 1. And it defines people better. It talks about qualified purchasers. And it opens it up where people don't have to make but $75,000 a year. It gets away from the accrediteds. Maybe you look at this, maybe you have your own ideas, but there's some things floating out there that we, as a group, can take the momentum from crowdfunding and all of these people and all of what we're doing and open it up and make it bigger than $1 million, get it to 5, and get it from accrediteds to qualifieds, and find creative ways, because I'm going to tell you, until I got into this mega holiday and I had to start trying to get money for myself, it's tough. And I am just baffled at the fact that people that are friends of mine, and I said, they said, well, gosh, we're not accredited anymore. We lost this, we lost that. They're smarter than me. And they can't put their $5,000 or $10,000 into an enterprise. It's just really rough out there. So I think we owe it to ourselves. We owe it to the jobs market, the entrepreneurship, and all the hardworking people to help get on the bandwagon and make change. With that, we have you met Ron, and we have Steve. Steve Cinelli is from PRIMARQ, Technology and Capital Raising. Douglas Ellenoff, Grossman, and Schole. It's a great law firm that's going to be talking to you. Over here we have Gene Massey. Gene is from MediaShare. Next to him on his left, we've got Vince Molinari, Gate Technologies. On his left, David Drake from the Soho Loft, who I've had the opportunity to go to at least 4 or 5 of his brilliant crowdfunding gatherings. And Richard the CPA, a New Yorker here. Richard Salute from J.H. Cohn and Company. So we will start, if you will. You want to just, wait a second, I'm going to get David to kick it off. You want to kick it off, David, and then we'll just go down the line, and each one of them are going to get to come up. Go ahead, and we'll go from there.
Well, good afternoon. I didn't expect to start, so this is great. My name is David Drake. I'm with LTJ Capital. Initially, we focused only on family offices, syndication thereof, mainly in Europe and the Middle East, some in the U.S. About a year ago, we started investing into a Soho Loft capital creation series, because I was thinking about bringing my LPs and my family offices into those events. And we started out in August last year. And relatively quickly, we realized that a lot of our speakers, and actually everybody here, have been speaking and been attending our events for almost up to a year now. So, I'm very happy to have my own little crowd hanging out here with us. Thank you, guys. And we realized a lot of them were actually sub-congressional witnesses running back and forth to D.C. all through the fall. And then we started seeing all these bills passing left and right. On March 8th, we got the Jobs Act passed the House. And on March 15th, in L.A., we're trying to figure out when Reid was going to bring it up to the Senate. And that morning, we found out it was going to come up, and we started talking about creating a trade association and an SRO. Of course, there's only one SRO that SEC told us, and we went down there several times talking to them one-on-one. It's only FINRA. So forget the idea of an SRO. So then we split up the 2 organizations into an advocacy group that's working with SEC on a daily basis and with FINRA. And we also set up a trade association, and now there's a couple of them nationwide. So we've been part of educating everybody about the crowdfunding for donations versus equity. And last year, the nation part, including some equity abroad, because it's legal in Holland and the UK and in Hong Kong, hit $1.5 billion. This year, because of the Jobs Act, we're looking at $2.8 billion, and we don't even have equity approved here in the US. But what's happening globally, as I was speaking in Stockholm with a co-founder of Sky, Bjorn Gerke, just a month ago, they're looking to the US for leadership. They're looking for you guys to get into this game and show them that you're a brand taking leadership in this space. You know, foreign money is coming in here because there's crisis all over the world. The family office is asking us how to get into this space. It's a very new space and there are very few leaders. Kickstarter is one leader, Indiegogo, as well as Rocket Hub. Rocket Hub is here in New York. Those are the three largest ones in the world. They saw their traffic double just the last 4 months. And we're talking about, you know, we're at the verge of you guys being able to brand yourself, being part of what we're doing in the future. And what we've created now and changed the direction is we're doing 50 to 60 engagements just this year, which means that anybody comes aboard the platform will be exposed to the industry leaders. Because we used to actually pull everybody's bio, and I got to meet everybody in our conferences in the space. So we have a good idea of where people are going, what the competitive landscape is, and it's brand new. Oh, I might have a good day. But that's about it. That wrapped it up for me. Thank you for your time, and we're going to go to the next one. Thanks.
Hi, my name is Rich Saluda. I'm the Capital Markets as an SEC Practice Director for J.H. Cohn. So I'm the boring one, so you can get into the exciting stuff in a minute. And, I've been doing this for about 6 months now, this being talking about this concept of crowdfunding from an accounting and auditing perspective. And the one notion that I have is that unless we have quality product that goes through the channel, this is a waste of time. Unless we really have valid businesses that need financing, that have an opportunity to grow and scale and build value, I think it's a waste of time. And I think that unless we create that true opportunity for these companies to be able to present themselves, I think we're going to have a real challenge. And the opportunity is to convince them that transparency wins the day. Transparency is what's going to make this make sense. It's going to be able to allow the marketplace to eliminate the chaff from the wheat. And the only thing that we can do as advisors, as our job, and this is the accounting profession that I'm referring to, is to make absolutely sure that these people that are going to go to you guys to look for money are valid investments. We can do that. There are arguments about independence, but our consultation to these companies can include, hey, do you guys really have something here that's worth money? Is your value perception reality? And can you, in fact, be able to operate in a community and be able to provide people with an understanding of what your values are? One of the ways that we do that is through due diligence. The profession has to figure out a way to be able to do this inexpensively, quickly, and effectively. We have to be able to come up with ways to assist the financial community who is going to invest in these businesses, a way to validate the information that we're getting. And we can do that. We're smart people, we can figure it out. In addition to that, I lost my notes because this thing. We got to be able to do that at a cost-effective way. We can't, you know, it's funny, we were talking about this at the table. We have with crowdfunding, if you want to raise more than 100 grand, you got to have a review. Well, what the hell is a review and how much does that cost? And, you know, when you talk to the auditors, and some of my brother in the audience might not agree with this, but auditors got to make money. We have to get paid by the hour, right? We don't have the upside, so you want to get paid for what you're doing. At the end of the day, we have to figure out a way to be able to allow these companies to get the right kind of attestation so that they can go to market. I take the position that, very much like venture capitalists, we're going to make maybe 1 out of 10 will be great companies. We have to take that risk if we want to participate in the market. I think that the only other point that I wanted to make is that you guys are the ones who are going to validate this asset class. If you produce value and value comes through your channels and people make money, then it's going to be very successful. If that doesn't happen, Why would anybody want to invest unless you got drunk one night and saw a website you thought was cool? So I rely on you guys to really be the ones to validate the asset class. With that, I'll turn it over to Gene.
Massey with media shares. We were all talking earlier today about how there's a tsunami coming of new financial instruments, and no one really knows what that is going to be exactly. The SEC has asked for comments on it, but none of us, even learned attorneys and great CPAs, all of us, none of us really know what it's going to be exactly. We're all waiting for the SEC to give their rules for implementation. What's really changed that brought all this about is the possibility of a new type of transaction method because of the internet. The days of, we joke around and we say the days of a broker calling up his customers on the phone is like going door to door with vacuum cleaners. And what's going to happen in the securities world is what's already happened in the world of maps and yellow pages. Media shares uses a process called direct registration, which is already being used on people's websites for S3 offerings. You can go on Home Depot's website and buy stock in Home Depot. We do exactly the same process using an S1. That enables you to do an IPO, a DPO, a self-underwritten DPO using direct registration. We still have to use a FINRA broker. We still have to go through the same rules and regulations. One of the things that we're doing is we have certifiedaccredited.com as a new website where we're going to be aggregating accredited investors and pre-qualifying them for all these new methods as they occur. And that's about all I have to say for now.
Hi everybody, Vince Molinari, Gate Technologies, co-founder and CEO of the company. Michael, David, and of course the association and everybody here, thank you so much for bearing with us and getting educated a little bit. And I can talk up here for days about this, and I'm mildly passionate about it, but I really want to get to the exchange a bit and some questions and answers, because I think that's really drives the process. But very quickly, established Gate Technologies in 2009 with a mission to bring transparency, efficiency, and liquidity to alternative markets here in the U.S. We define that here stateside as restricted stock, private company shares, limited partnership interest warrants. We really, and it goes to a lot of what Michael spoke about earlier. The fact is we have a broken capital formation system here. We could talk about 500 IPOs going to 120 a year, and that's dysfunctional. We could talk about whether that was Reg NMS, order handling rules, decimalization, Sarbanes-Oxley, or all of it. The fact is, it doesn't really matter, it's broken. When we started to tell the story 3 years ago, we got a lot of that anti-Wall Street. Hey, boo-hoo-hoo, Wall Street isn't making money on the IPO anymore, who cares? What we lost sight of is the investment practice. The fact that we need to put capital to small companies, mid-sized companies, and the entrepreneurs who are our engines of growth in this country, which have built this country, and which are our job creators. So we felt we had to find new ways to reinvent or change the investment practice. People talk a bit about this being a revolution. I don't really agree with it. It's an evolution. If you look at every major asset class in the United States, and perhaps even globally, from the New York Stock Exchange the specialists being displaced with electronics, people said that was never going to happen. Next thing we heard was retail was never going to trade electronically. They're not smart enough. We can't make the PC secure enough. Well, hello, Charles Schwab and E-Trade. Every time you begin to create efficiency with electronics, we heard it wasn't going to happen. Well, next, fixed income, foreign exchange. So we took those same practices and said, let's start from the top. What are we really missing here? We became much more trading markets than investment markets. And you can tell me you're doing 3,000 trades in a nanosecond to try to scalp 1/100th of a mil these days. That's trading. That's not investment practice. When we start to think about getting to settlement date as an investment, that's the wrong philosophy. Myself being a recovering investment banker, I'm really thrilled with speaking to this audience because I haven't had the opportunity to really speak to an investment banking group. For us, it was really about how do you remain relevant to your customer? How do you capture alpha in new ways? What did Facebook teach us? And to me, it taught us that private company marketplaces can be very efficient. What did we do? We took that alpha creation that was only afforded up at the IPO process to maybe a limited few. We all know the game for a long time. How many shares you're putting in? You're lucky you're getting 50 out of a 10,000 allocation, et cetera, et cetera. What happened? We had valuation expansion in a private company from a few billion to $80 billion in a 2-year period. That never happened in a private company before. So the lights started to go off and people said, well, maybe the investment practice is moving down cycle a little bit. So as investment bankers, there's a number of things that I think happen here. We took the whole process and we felt we had to embrace regulation. Having been regulated our whole careers, we embedded the technology into a broker-dealer here in the U.S. called Gate U.S. We became FINRA approved for our trading systems. We took the next step and became the first alternative trading system for 144A securities aside from NASDAQ themselves. And we took the next step for limited partnerships pursuant to a private letter ruling with the Department of Treasury to become a qualified matching system. Why do I tell you all that? Because we began to think about the markets differently. 2+ years ago, I wrote my first letter to the SEC regarding the 500 shareholder rule. And frankly, that was well before the Jobs Act got fashionable. But what it taught me personally is, just like this crowd here, and I'm not just going to talk about crowdfunding, because the Jobs Act is so much more than just crowdfunding, we were able to affect a change. Going back to lobbying with the SEC directly at Capitol Hill, little old Vinny from Queens, congressional witness. Why? Because we stepped out and started to educate why these markets were important and they shouldn't be shut down, they should be expanded. When we talk about the solicitation ban, when I first sponsored the removal of that, people said that would never happen. We've had this since 1933. And our pitch to Congress back then, before it went to Senate, was very simply, a drug company can go out and you can advertise to anybody in the country. Doesn't mean that you can go and buy that pharmaceutical product. What do you have to do? You have to go to a doctor. That doctor has to say, yes, by the way, you qualify for this, you need this. Here's a prescription, go to the pharmacy. So we said, if you take the evolution here, the evolution is social media. The evolution is the webification of financial services that we're going to. I think when you look at our markets in the next 3 to 5 years, especially in the next 10, they're going to look very different than they do today. So we felt that if you could take the power of social networks, if you could take advertising, whether that's television, whether that's radio, and be able to broadcast a private offering, a 506 offering. Could you imagine? You didn't need a pre-existing relationship with the person, and you could broadcast to masses? That's a really darn good thing. How do we get more distribution more efficiently? Through that manner. But you need a check and balance. What was the check and balance? Well, coming back inbound, that subscription had to come through a broker-dealer. Guess what? We're FINRA regulated. That all makes sense for all of us. Well, guess what? They wanted some additional protection, so it had to be an accredited investor or better. Would we have liked it to be straight retail? Sure, but it was a compromise in the legislation. And again, I can talk about this on and on. But the long story short for us is we don't deal with individual investors ourselves as Gate. We're basically communities. So we want to engage the broker-dealers, the investment banking firms. We have a primary issuing portal that FINRA absolutely loves. We white label that and put it out to the broker-dealer. It does your syndication, your watermarking of private placements, your numbering, archiving. Pretty cool stuff. And really about creating efficiencies, and again, we can talk about it, Reg A going to 5 to 50 million. Absolutely amazing. Never thought it was going to happen. So it speaks directly, I think, to what Michael is speaking of earlier. It's about education. It's about letting people know what's available. The ability that this is the biggest bipartisan bills that have passed in probably decades, and it shows the power of starting something from nothing. And this 270-day rulemaking process, this 90-day period for comment, everyone in this room should be sending in letters, comments, because it does make a difference. And the regulators are listening because the White House is sitting up here and signed off and pushing these initiatives to happen. So anyway, I'm sorry I could drone on about a whole bunch of other things, but off to Doug. Thank you.
I'm going to sit to it. I have very short legs, want to see me stand. Unlike Michael, I was actually quick on my feet, and we got the URL crowdesq.com to be cute and to be with the crowd. So you're welcome to go join it. It's got information on the site for everybody. We're a law firm, Ellenoff, Grossman, and Schole. We've been in the New York capital markets for 20 years. We are 60 lawyers, 35 of which are securities lawyers. We consider ourselves to be programmatic lawyers, meaning we help new programs evolve over time. While we represent 50 public companies, we've been integrally involved in IPOs. Last year we were 4th in the country in activity levels in IPOs. We've been very involved in the SPAC program, helping formulate what we call Generation 3 and raise billions of dollars, or work with broker-dealers, who've done the raising of the capital. We're number 1 in the country in pipes and RDs. And so when crowdfunding came along, we said that this was a perfect new program for us. It's below $1 million. Most law firms in the country won't be particularly interested in it. We thought we were duty-bound to get involved because it was something that, working with the SEC and FINRA, we could help translate the industry's issues and concerns and work with those agencies to make the program as good as it hopefully can become. Within the 35 securities lawyer practice that we have, we divvied it up. There are those who will deal with the agencies, there are those who will deal with the portals, investors, the entrepreneurs, and the service providers to the portals. We actually think it's an incredible opportunity. We always express appreciation to Vince and David for the efforts through the legislative process, which were really remarkable, and there were others involved in that as well. We would encourage the investment banking community to take an active view of it. I think Mike was correct. While it starts at $1 million, it will, if we are responsible reference points for what happens over the next several years, it will inevitably increase. There is also conversations with the authorities that $1 million is not the aggregate amount, that we're exploring whether or not you can do hybrid offerings, side-by-side deals, whether or not institutions are part of the definitional interpretation of what an investor is. So we hope the program is initially successful. We are not concerned about the issues relating to fraud, particularly in the context of the enthusiasm for 506. But we do think people have to be very careful as to how they proceed, and we look forward to working with everybody as the program evolves. Thank you.
Hi, I'm Steve Cinelli, and I'm founder and CEO of a company by the name of PRIMARQ, based out in Silicon Valley. As background, and I'll try to be brief because I know we want to have the exchange discussion. I'm a banker by background for all my career. Most relevant to this discussion is about 12 years ago, I was a founder of a company by the name of Off-Road Capital, which was probably the godfather of the crowdfunding movement. What we did back then was recognize the power of the internet to facilitate capital formation. If you think about capital formation or raising money for companies, there's a dialogue between an issuer and investor. We recognized that in the private finance process back then, that it was very analog, to use sort of some of the technology term. You tell one person a story and then you tell the same story to another person and so on and so forth. Well, we recognized at that time that the power of the internet allowed you to tell the story once to a plurality, so a lot more efficient information flows. Off-Road, during its heyday, we aggregated about 10 to 12,000 accredited investors worldwide, representing probably about 22, 23 countries. We could raise growth capital for typically venture-backed companies between $3 and $15 million in a matter of days in $25,000 increments. So the power of the web, the power of the net was sort of changed the rules of capital formation. And so it's nice to see how the crowdfunding movement has evolved. Currently, PRIMARQ is another private capital market, but in another maligned area of capital need. Not looking at financing companies, but rather if you think about one of the largest capital markets in the United States, if not abroad, it's the housing space. Housing is largely a leveraged financed industry. In the United States alone, it's a $15 trillion asset class. There's about $2+ trillion of annual financing that takes place, but of that financing, it's all debt. Certainly aided by the government support, aided by the securitization process, and so on and so forth, but it's all debt financing. So PRIMARQ, our agenda actually is to introduce an equity capital market whereby third-party equity investors can come in, co-invest with owner-occupants, homeowners, home buyers, reduce the level of leverage, bring housing affordability and sustainability to a more rational level, just deleverage the system. So again, PRIMARQ, we think we're onto something that's pretty significant. As I said, it's a $15 trillion asset class in the U.S. On a global basis, probably about $125 trillion. So we're after a big fish, and technology allows us to do at least pursue what we're doing. So with that, I guess we'll open up the dialogue on the crowdfunding fund.
Before we do that, I just want to say that this is the room tomorrow from, I think, 9 till 4, that the companies, the issuers who did the 10-minute presentations will have tables. And this is where you can come. Now, if you don't have a particular appointment, don't be shy. I think it worked in Orlando. You can come up here and see if somebody's busy, or come in and go to the table when nobody's there. Some people may only need 10 minutes and they have 15 booked. Sit down and talk to them. Say, well, do you have an opening? Can I come back? This is an interactive relationship tomorrow, and we really want to see it work and work well. So be aggressive. Come up here, go down there, talk to the people, get an appointment downstairs, upstairs, or just come plain, just look at the tables, and if nobody's sitting there, walk up to them. You're welcome to come up here all day during the day tomorrow to see if there are people you can talk to. Now, for questions, you know that we have some tremendous experts and power up here, people that have been involved in this process from the beginning. We want you to feel free to ask your questions of whoever. I'll try to help speed it along and moderate it. Mikey?
Hi, gentlemen. Thank you again for coming today to NIBA. These are all very important issues, and you've touched on most of the major topics. One of the topics that I think a lot of us were interested in, since many of the broker-dealers may be getting involved, depending on FINRA's rules, of course, with crowdfunding especially, the costs involved. One of the gentlemen spoke about attesting to some of the accounting numbers. How much that'll cost, $5,000, $10,000, maybe more, instead of a review, disclosures and due diligence. $5,000, $10,000, maybe that's going to be small, maybe there'll be some appraisals in some companies, maybe some assets need to be valued, maybe that number will go up. It appears to me, when I do the numbers, that we're getting north of $50,000, $60,000 minimally, even for small companies. Then the site obviously has to charge something. They can't charge a commission, so the site has to charge a fixed fee. Whether it's a $100,000 or whether it's $1 million, they got to charge a fixed fee. So it sounds to me like we're getting close to $70,000, maybe $100,000.
So does anybody on the panel want to tackle this question?
Yeah,
I'll
take it.
How we make
The
money?
question is, summarized, it appears there are a lot of costs to get involved in even a crowdfunding for $1 million or under. What kind of costs are going to be involved, and
How we make money?
Who's going to pay for it?
Yeah, I mean, from my perspective, it does a couple of things. One, there is a cost. People won't work for free. I don't know anybody who wants to do that. I mean, I'll personally make investments in clients because I think I bet the rider, not the horse. I think guys have good business plans and they can execute. We make an investment in the short term. Not everybody might think that way, but at the end of the day, there's a cost. Even the investment that we make, we have to get paid. There has to be a cost associated with creating the information. It's not for free. There's a reality to it. So what does it do? It eliminates people. To me, it eliminates the hobbies, which is a good thing. And two, it's going to drive the amount that you raise. There's a reality to it. If you're going to try and raise $100,000 and have to have a review and all the other bells and whistles that go along with that, does that make sense? Doesn't make sense. Quite frankly, you as the advisors have to be a big part of that message. There's a certain cost to it. You know, I kind of analogize this to when you buy your house, you have a mortgage, You paid for the mortgage. You're going to pay closing fees, and the lawyers get paid, and the accountants, everybody gets paid. At the end of the day, it's a similar circumstance. There's a cost to this. It's a reality.
Any other panel members want to join in on this one?
Sure, I think there's an important point here, and there's a major differentiation between a crowdfunding portal and a broker-dealer. Very significant in that...
And you are both.
We are a FINRA member. We are not a portal. I don't think we'll ever get into the portal business ourselves. What we will look to do is extend our technologies to the various portals and create efficiencies, and part of that is looking to reduce some of that cost. Going back to my testimony in Congress, I did not believe that we needed new regulation for this. I felt that we had a wonderful infrastructure that's called the broker-dealer community that is already governed by FINRA. Why are we creating yet again more regulation? However, that's the way it went, and the concept of this broker-dealer light or portal community was developed. Well, what does the legislation say? You have two, the SEC and FINRA, or the SRO, which de facto is FINRA, has 270 days now to write the rules associated with this. And there's all kinds of wonderful rules that are going to come out, but one of the most important things that has to happen is the FINRA has to write a new membership process, a new perhaps net capital equivalent, maybe it's going to be watered down from what we know, for the portals because they are going to be members of FINRA. So that's a pretty long process. It's due to be finished January 1st. I'd be willing to bet that doesn't happen, and there's probably an extension that's going to be sought by the SEC and FINRA. So I think what you have on one side of the equation is a lot of what I would say is the webification world, the great app developers, who are sitting on the sideline just anxiously waiting to go into crowdfunding for equity business. Yes, maybe they could, just as a backdrop, I helped form with David crowdfunding intermediate regulatory advocates to go out and promote and talk to the regulators. There's probably 120 portals that are part of that membership at this point. None of them who actually do business. So I think the efficiencies are going to come for the broker-dealers. The efficiencies are going to come from the FINRA members who are already being governed by the current regulation that are going to have some amendments to those and maybe a new business line associated with crowdfunding that I think are going to be able to operate much more efficiently. And if you leg technology into it and use social media, use some of the networks that are out there, I think there's money to be made. Do I think it's huge money? No. Frankly, that's why I think the big game changer here is really on the solicitation ban removal when you start to look at our traditional 506 and the ability to scale that pretty rapidly.
You know, I don't know if he's here or not. I'll come right back to you. But Chuck Hayes, if Chuck is here. Chuck had emailed me and said, can you please gather sources of where you can go for resources and where, so that we can stay up to date. So I've gathered 6 or 7 blog sites, and I'm putting them up on my website. Under the left-hand column is a section that says resources. And if you click on it, you can cut and paste all of the domain URLs and then put it into your system. And those are tracking this on a daily, weekly basis. And it's a way to get more information. David?
I wanted to add 2 more points. You know, having had all these conferences for the last year and having met everybody, you know, they're automating all the processes. I'd say 60% of all the groups and people involved in crowdfunding for equity are looking to automate all these processes. On the high end, you know, we have a former SEC lawyer who's actually doing compliance and background checks, and she's going to charge $3,000, which goes back to what the cost is going to be. We have very progressive accounting firms like Richard and J.H. Cohn, who's now willing to invest into the space. So the prices are being pushed down and automated, and it's going to continue doing that. And hopefully, you know, they'll be able to plug into your broker-dealers to make it efficient. But I think the upside here is twofold. Brand recognition as a leader in your space, in your community. You know, being progressive and saying, hey, we are the brand at the forefront of this. That's important for your organizations. And secondly, it'll be important as well that, as Doug was saying, SEC has not precluded that institutional accredited investors can co-invest. They actually said they're considering allowing co-investment in parallel, which means that your clients who might want to invest 5, 10 or more million or less applies to this. And they're going to need you guys to identify what those opportunities are. And thirdly, which I didn't mention, is You know, the angel community right now, when I was down in DC with them, ACA, you know, they're looking at, look, you know, what's going on in this industry? How can we play along? How can VCs play along? And in essence, they're saying, well, we can foresee that in the future, you know, angels or your clients will walk in and set the perimeter of valuation and use crowdfunding as a follow-on, add-on for your existing deals. So let's say you max out on your investors and you need a follow-on to close it out. Then you kick in with crowdfunding, which makes that a very interesting tool for everybody here.
One thing, another thing is we're going to be pushing through the NIBA portal updates on a regular basis, so I invite all of the panelists here if you want to contribute to that. We're going to try to do it at least on a monthly basis as to what's happened the past month and what we're looking forward to this month. Go ahead.
To what extent has the successor to Rodman and Renshaw moved into this space?
Could you repeat the question?
He wants to know about Rodman and Renshaw and whether they've moved into this space.
As far as I know, I don't know what they're doing right now. Maybe somebody else in the panel?
I think you're talking about the direct edge fund. Is that what's
Oh, that's right, I remember Marcus. Yeah, direct market.
That's for public companies. This is inherently private companies. Public companies cannot crowdfund.
Okay, we have some more questions from our audience over here.
Michael, members of the room, and people going back to firms, since Sarbanes-Oxley and FINRA advent in 2007, we've watched FINRA and the SEC effectively diminish our membership from 5,000 to 4,000 members, 20% cut. Clearly, to me, this is a method to even reduce our membership more by coming up through another device. My question is, to what extent does our cooperation with portals, which seems to me to be a competitive in accessing our market, to what extent does our cooperation with these portals have us eat our own lunch?
Well, let me just say this, and then I'm going to turn it back over to the panel. I think you look at it as an opportunity. The more entrepreneurial people that we can help get $1 million, and hopefully the number will go up, the more we have the opportunity to get people to a scalable business model that we as investment bankers can take and move on up through the ranks and have a proven process. I see it as a necessary, needed breeding ground to help entrepreneurs get on horses and ride and show us that they can do it. Gene?
I don't think you need to worry about the crowdfunding, and I'll tell you why. Because entrepreneurs are not going to be able to afford it. They've made it too difficult for an entrepreneur to go out and try to raise $1 million. If you got to do a certified audit, a background check, if you own more than 20% of the shares, you have to do a background check. I don't think it's going to be this big thing that everybody thinks it's going to be. I think it's going to be a mess for about a year. But let me tell you, to answer your question, what will happen? A while ago, I said something about brokers calling up people on the phone, is like going door to door with vacuum cleaners. Don't let that scare you, because people are still going to invest, and you're still going to need a FINRA broker. There will still need a FINRA broker. What you will effectively do is turn your system into an electronic system. You will adapt one of these platforms, and it'll go through your same brokerage. You will effectively be able to access a much, much larger crowd than you could ever access calling up people on the phone. You will be able to publish your actual offering online and use your brokerage as a means of reaching out to millions of people with an offering. I don't think you have anything to worry about. You will adapt to the new methodologies for selling shares online. Right now, direct registration can open an account and sell shares for $1 without someone having to pre-fund a brokerage account. Without having to pre-fund a brokerage account, they'll be able to go on your website for your brokerage and actually purchase shares right there without having to put money in advance. They debit your checking account for the share purchase. You've got something called quick shares, which will be able to pre-qualify somebody for share purchases, and then they'll be able to buy shares just debit. Because if you had to go to Amazon, if you had to go to Amazon, And they said, well, you have to put in $1,000 first, and you have to buy 10 things, and there's going to be a $50 charge before you can buy anything on Amazon. That's effectively the way that stocks are sold now. So you should be able to go buy some stocks and have it and be able to pay for it with a credit card or an ACH debit. That's what's going to happen.
Doug, and then Steve, and then I'll come back to you.
And the second part of that same point is that portal may not market an offering by definition under the way the act is constructed. The entrepreneur that's seeking to raise capital can say, I am involved in a crowdfunding offering. You may encourage people, and actually can't encourage people, just tell people that you're doing that. They go, and you can tell what portal they are, your offering is on. You may not tell them the terms of the offering, and you may not do anything beyond that. The portal can say, we are in business to raise money for a variety of entrepreneurs, and then the person who goes to that portal can seek your individual opportunity or look for many others and do it or not do it. But it's a much more passive approach than what a broker-dealer will be able to do with the same technology online. So a portal is a distinct animal from a broker-dealer, and the broker-dealer is going to be able to be much more active in what they do, as well as the things that they can do. A broker-dealer that's also a registered investment advisor can provide advice, whereas a portal is by law not allowed to give advice. And then the last thing I'm just going to respond to is the first question, which is the number of entrepreneurs who are trying to figure out how to do online in an automated fashion has been done by either professionals or in other by the hour sort of manners is extraordinary, and there are people who are doing not just build business plans, but in a highly standardized, automated way. It imposes the burden on the entrepreneur to do the work that maybe I would have otherwise done. But if they do it, and they can do it in an intelligent way, the cost of the legal services to provide full and fair disclosure online with a virtual data room is going to drop dramatically. So there are many people who are trying to address the transactional costs. And even though if they're below $1 million, it's not particularly interesting to the investment banking community today. For the non-accredited investors that come in, there may be the other offerings that go on simultaneously, as long as there's not an integration issue, to make it more attractive, or if the amounts go up over time. But we wanted to bring it to your attention now because we do think there's a filtering component to help incubate new entrepreneurs in a very meaningful way.
Steve?
Who takes the know your customer hit?
Hold that question, because Steve has a comment before we get to that.
I just wanted to make a comment to your point of competitiveness with the portals and the PDs. I think at the end of the day, there's a lot of this crowdfunding model industry that is yet to be decided upon. One of the big things is basic business model of these portals. You're looking at relatively small transactions or exceedingly small transactions. How much compensation can you derive by with a transaction that is up to $1 million, but we sort of anticipate most of the transactions will probably be in the sub 250 range. That's not a lot of not a lot of compensation for the portal to generate. And you've got customer acquisition costs for the portals, building up their networks, the cost of technology, so on and so forth. As perspective, the three largest non-equity based crowdfunding platforms, Kickstarter, Indiegogo, and Rocket Hub, Kickstarter of course being the largest, I think they did about $65–70 million worth of financing since last year, for 2011. Assume that they picked up about 5% of the funds that were raised, so they had about revenues of about $3 million. But they had 65–70 people on board. That $3 million doesn't go a long way. So I think the question becomes, can you actually build a business model, a revenue model for sustainability for these portals because of the sizes of the transactions? That might suggest that maybe this is a great plug-in play for the broker-dealer network because they have other things to do. Crowdfunding, I see, is not only a great way to aggregate capital in small lots from the John Q. Publics, but the example, and some of you may be familiar, there was a great success story on Kickstarter about a month ago, a company by the name of Pebble Technology. In the course of 30 days, they raised $10.8 million. How did they do it? They went to their crowd. They had a great social network. This was a company that produced a consumer product, a watch that tied into various electronic devices and whatnot. And so they not only raised capital, but what they did was build a customer base. And I think that's really an important part of the whole crowdfunding pursuit, is that you're building a loyalty base, you're building customers, you're building awareness that helps well beyond just capital coming in. And so there's a lot to be said about the sort of the crowdsourcing side of crowdfunding and just the exposure. So,
Guy?
Yeah, thanks, Mike. One thing, this crowdfunding just came out of nowhere, and one thing I don't hear anything about is disclosure, what kind of information the investors are going to get. I have another name for the act that may not be popular in this room, but it could also be called the Microcap Fraud Act of 2012. There's a lot. Anybody that's ever been banned or sanctioned is back in business with this act. I think there's a real danger for a lot of bad transactions, and this thing blows a hole from everything from Dodd-Frank back to the 33 Securities Act. I mean, the whole point of registration and disclosure, everything we've had under the securities laws is just out the window. So, it's...
Well, I'm going to make a comment, and then I'm going to turn it over to the panel. First of all, the rules haven't been set yet. So we don't know what they need to have and what they don't need to have. Environmentally, if you watch any of the documentaries, we are in a pool or ocean of germs, and we happen to have, fortunately, most of us, an immune system that helps us out. When this floodgate opens up, what's to say that the people that have been banned will be allowed back in? There will probably be a rule, maybe, if you suggest it, that they not be allowed back in. There are ways to deal with these issues. That's the whole point of this lunch and this talk and this panel, is to help develop some interactive relationship with the regulators who have been given the task to come up with these rules. And I will turn it over to the panel for further comment. David, you wanted to go, then Vince,
quickly,
and
and I
Steve.
know everybody else wants to address this. So when we were down in SEC talking to them, for instance, Rocket Hub, the third largest in the world, joined us for the first meeting. And they're in essence had, well, granted they're not equity, it's not allowed yet, but they've had zero stakes of fraud. Of course, you can argue, well, what about afterwards? Well, their platform allowing companies coming in to market. So they've had zero cases, and they've had algorithms, and they're working with the microcap division of the SEC to see other ways of doing it. Will there be fraud? Absolutely. Can Pebble watches that were presented for us in San Francisco a month ago take the money as salary and walk away, and they wouldn't be fraud, but they paid themselves? Yes, that goes for any company. Like you said before, Michael, wait a minute, you're using the money for something else. You're running that risk regardless. But it is important to identify groups that might be fraudulent initially right away. For instance, Kickstarter about a month ago, there was a programmer, a gaming programmer, who by the crowd was identified within 48 hours and kicked out that he actually taken part of the gaming from his previous company. And the crowd will be unforgivable. Now to the second part of this, this is going to become one of the most transparent, disclosures that you're going to have, because you're going to have maybe 1,000, maybe 2,000, maybe 500 investors, and they're going to be asking the executive team every single day questions. So unless a company has an FAQ answering all the questions from the beginning, they're going to drown in questions, because you're going to have open books ongoing every quarter, every year. So these are a couple of them, but you're right, they're going to be fraud. But is the fraud going to be 10 million or like Enron? No, they're going to be small. And most fraud is one-on-one, except Madoff, of course. But they're still one-on-one, and most people don't hear about it. It might settle, and not everybody knows. In this scenario, everybody will know, because the crowd is watching you.
Right with this, and it's also a topic this room should address, is the SEC is out of control in the microcap area.
Well, that's what I'm hoping. That's what I'm hoping is going to happen here. That people will take advantage of this.
But this is a huge issue right now with the members, the bulletin board companies that we underwrite. We get physical certificates out there. The clearing firms, no one wants to accept it. DTC's put in listing standards they haven't told anything about. So on one hand, you got all this new investment that's going to come in on the front side, and you can't get the securities on deposit. It is a huge problem right now.
Well, on the microcap fraud, as I put in the second or third slide, regulation and all this didn't help too much with Bernie Madoff and Alan Stanford. So that's not the issue and the answer. And I think David pointed out, you have fraud everywhere, and it can be controlled. Vince wanted to make a comment, and then Steve and Doug, did you want to make one?
Sure.
Okay.
I'll try to make it really brief. There's a couple of hot buttons that surface on the KYC issue, right? It's really not dealt with the portal, right? So the portal, unless you own a broker-dealer, dealt with things. Wow, this little thing called suitability requirement. And I will tell you firsthand, even when you have those customers that shut off speculative, and they're taking all the risk, well, amnesia a year and a half and 2 years later sets in, and oh my goodness, I didn't know how risky this was. So there is a huge amount of risk associated with private market trading. Certainly with crowdfunding, most of those companies just by large aren't going to work out. Guess what? So going back to Michael's point, there's a big red thing that should go across and say, buyer beware. Guess what you're buying is you're probably going to lose your money. The portals aren't subject to that. However, they're really dealing with very small amounts of money and the aggregate amounts. This is an iterative process, and I think, as Doug said, regulation is going to continue to evolve. Maybe the size of crowdfunding is going to increase or not, but it's important to engage in the process. And the gentleman in the back, this is really, whether you like crowdfunding or not like crowdfunding, this is not, the Jobs Act is not about micro fraud, right? I'll sit here and tell you firsthand, I lobbied very hard for Reg A revisions, and we're not in the public market side, but I thought if you could take a Reg A offering and have the ability to go to 50 million instead of 5 million, that makes it pretty attractive for more underwriters to step into that game. So look at the IPO on-ramp, which is part of the Jobs Act. It has nothing to do with crowdfunding. So in traditional Washington fashion, they bundled a lot of different bills together for passage, well, some which had nothing to do with each other. And I could be one of the best conspiracy theorists as well, but I will tell you that in FINRA, the SEC would love to have never heard the word crowdfunding portal. They don't want to deal with this. I sit and talk to them for 4 hours just the other day. This is a thorn in their side that they'd rather just have down. We're trying to find ways, and again, this is contrary to some of the portal members that are part of the association. This is not where the puck is today. I think it's where the puck is going. And I think this is going to become more of a broker-dealer activity. I think it is part of the investment continuum that's earlier over here at crowdfunding. Some success are going to create some more private companies that can be funded. Those private companies, by some success, will become pre-IPO companies. And if we're fortunate, we're going to a bit more of an IPO cycle.
Steve and Doug.
Yeah, I was just going to echo this comment. It is let buyer beware. You think about what's transpired in the secondary markets, your second market and shares post, some of the trades that took place before Facebook went public, billions of dollars of transactions, investment decisions made without any information. Just, it was all on hype, speculation, and revenue speculation on this before the company filed their S1. Then with the disclosure information, we saw price come down to where it probably should be. But even with disclosures, Facebook did eight revisions of their S1. Groupon, I think 8 to 9 revisions of their S1, continue to change their accounting practices and disclosure mechanisms, this and that. Is that even with the quality of the disclosures, it's the content, but it's more importantly the reader of those disclosures and what act they take in terms of making an investment decision or not. There's a lot of open items in the Jobs Act relative to crowdfunding. Certainly disclosures are, is there going to be a shortened version of an S1 Lite? What's the ongoing reporting requirements for these companies to their investors? How much background or how much information you provide on the principal's background. So good practices are being looked at, what's best for the investor community. The SEC is really looking at protecting the investor. That's their big agenda. That's why the 33 and the 34 Act came in terms of disclosing to the public. This is the nature of the company. And if you want to play on the exchange, if you want to be publicly traded, then you have to default to the 34 Act and you got to report. All good best practices. And I think the crowdfunding industry is moving down that path. Nothing's been decided. That's what this commentary period is for. There's a lot of dialogue between the regulators and members of the industry, accountants, attorneys, so on and so forth, to come up with a framework that does protect the investor, but there's no assurance that any of these investments, these small company investments, will become the next Google or Facebook or whatever. These are companies that, in the greater good, need capital. Crowdfunding is part of the Jobs Act because the assumption, and it's a true assumption, that most jobs are created at the small business level. So this is a way to move capital that's heretofore not available into a very required, necessary part of our economy. And yeah, you can dismiss, you can criticize, you can say this is going to be fraught with fraud and everything else. I look at it on the flip side, the social policy issue. This is a great way to throw more money behind the USA and the job creators, which we desperately need at this time.
Okay, someone try to cut you a little bit, Doug, and then we're going to have to wrap it up.
Just the first observation, nobody can reconcile what's going on with DTC, the 506 issues, the increased incentives for companies to stay out of the regulatory environment and shares post-second market environment with what's going on with crowdfunding. First of all, the SEC didn't come up with it. It's being forced upon them. That doesn't mean it's not necessarily a good thing. The fraud is an interesting thing. I don't believe statistically more people are going to take money in this ecosystem than in any other system. If fraud can be broadened to mean that people are going to invest money into entities that they may not fully appreciate, which you can get tagged as a defrauder if the SEC comes after you, isn't what I think it could happen here. But the standardization of the disclosure as required by the Act is not unlike a lot of SEC disclosure. There has to be full and fair disclosure of the opportunity, use of proceeds, the financials, background checks. The portals have to be licensed by the SEC and by FINRA in all likelihood. There will be education component to the whole thing. And there's going to be an absolute blueprint, an electronic footprint, as Vince was pointing out earlier, where before somebody put any money into the deal, they have to go through an entire series of web pages to confirm their understanding on their own time frame, not with a broker leaning down them and telling them just to sign on the dotted line. The fact that there are 45% fewer public companies in this country is another problem because we are not properly funding entrepreneurs in this country. Several of us just got back from Salt Lake City. Not everybody knows the right people, went to the right schools, who work in Silicon Valley to get those companies funded. This is an opportunity to give seed capital to people who actually deserve it to try and do something interesting. And maybe it creates a new product offering for all broker-dealers in this place. To me,
Hold it, Guy, I'm trying to wrap it up. I said I was going to wrap it up. I'm sorry. So, hold it, please.
No.
Hold it, please. Calm yourself down.
Michael.
Guy, I am trying to wrap this up. Hold your comments, please. Guy, please hold your comments. Guy, hold your comments, please. I want to thank this panel for taking the time to come here. I appreciate it very much. If you'd join me in a round of applause for the people that I encourage you to interchange with them, interact with them as we move forward. Will you guys be around later today, tomorrow? See them in the hallways. I want to thank you all for staying late. I know the whole program, the whole conference is running behind. I'm sorry for that, but we appreciate you staying here. I'm sorry I had to cut you off, Guy. but they told me we had to wrap it up, and we just didn't have any more time. So thank you very much. We'll see you downstairs.